You're listening to the Cash Podcast, creating affluence, success, and happiness with your financial surgeon, Adam Koch, president and portfolio manager at Libertas Wealth Management Group at libertaswealth.com.
All right, happy Friday, everybody. I'm recording this on Thursday, July 29th from my home, and I have been losing my voice a little bit lately, so bear with me, but I promise I'll make my way through it. So today, we're going to be talking about using virtual reality in a study specifically done at Stanford University, where they used virtual reality to see how people changed how they invested their retirement savings and how they allocated their money. And with all the Googles and Facebooks and Microsofts and Apples making up such a huge part of the S&P 500, they've been pulling the market higher, and I keep hearing more and more people talk about the potential stock market correction in the not-too-distant future. But the market, if you don't know, has a bunch of dirty little secrets that most investors aren't aware of. So, for instance, the median NASDAQ stock is down 18% off its highs. Let me repeat that. Median and NASDAQ stock is actually down 18% off its highs. The average stock in the S&P 500 is down 8.2%. If you look at mid-sized companies, so the mid-cap index, the average mid-sized company stock is down 13%. If you look at small caps, the average stock is down on the small cap index 18%. And then when you look at the entire New York Stock Exchange Composite Index, the average stock is down 17%. And these are numbers as of yesterday, so that would be Wednesday, July 28th. Obviously, today might have changed some of those numbers, but just want to make sure that we're being honest and accurate here. So maybe the stock market is already been in a correction, I guess, is what I'm suggesting. And maybe, just maybe, we should be focusing less, and this is important, so maybe we should just be focusing less on what the Dow or the S&P 500 is doing, and instead focus on what we can control, which is our retirement plan. And before I dive in here, as always, a few housekeeping items. If this is your first time listening on iTunes or watching on YouTube, then thank you so much for joining us. The Cash Podcast is produced weekly, with rare exceptions, I should say, like last week. And as stated in the intro, Cash stands for creating affluence, success, and happiness, and that's our mission. My hope is for you to learn a little bit more on each and every episode so that you become more successful, wealthier, happier, and more educated than you were when you first started listening today. So come back often. Check out our older videos for ideas on education and different things you're looking to learn more about. Subscribe on iTunes and YouTube. So if you're a treadmill listener or a car listener like I am, check out the iTunes page. And then if you're more of a visual person and you like to watch, we're on YouTube every single episode. And in addition, you can also follow me on Twitter at Adam Koch and on Instagram at Financial Surgeon. Last but not least, we're not having any links or charts or anything like that today, but all visuals and educational resources are available on our website at libertaswealth.com. And if you ever want or need anything else in terms of images after the fact, feel free to give us a call or shoot us an email. We're happy to provide. All right, so let's just go ahead and jump in here. So as usual, I always have a quote because I love quotes. And this week's quote is from Stephen Covey. And he says, "The key is not to prioritize what is on your schedule, but to schedule your priorities." Makes sense, doesn't it? And I think that goes a lot into what we're going to talk about today. So everything kind of stemmed, this idea for today's podcast stemmed from a book that I just finished reading called Thinking in Bets by Annie Duke. And Annie was a World Series poker champion, and I wasn't so interested in the information about her poker playing as I was in the idea that every outcome has a probability. And what happens is most people have a tendency to think in terms of certainties or absolutes. They tend to think, this will happen or that will happen, and it's a very binary thing. Whereas Annie suggests that instead we should think in probabilities. So, for instance, if you're asked a question about succeeding or failing in something, or if something's right or wrong, you have a 75% chance, let's just say, of succeeding, but you also have a 25% chance of failure. So in the case that you're wrong or your beliefs are wrong, then you shouldn't be surprised. And that can go further from there. So this is where it got really, really interesting for me, is that we can make, as human beings, we can make good decisions and have bad outcomes. I think we all know that. We've all in our lives made a decision about something that we thought was a good decision. We thought we'd made a calculated risk, let's just say, and it turned out to be, in the end, to be a bad outcome. We couldn't control the outcome, of course, but maybe in the beginning when we were thinking about it, we said, well, I'm going to do this because it's going to guarantee me success, or I think this is going to work, so it's going to work. And then we end up being disappointed when a period of time goes by and it doesn't succeed right away, or it doesn't work right now, or all the time. It doesn't work every time we do it. And retirement planning is one of those things that is so applicable, which is why I loved this book so much, was because it applies quite directly to retirement planning, even to investment management and things of that nature. So we all, as humans, this gets more interesting, by the way, as humans, we all can make good decisions that end up resulting in bad outcomes. But what about those times when we make a bad decision and end up, in hindsight, they have a good outcome? And these are almost more dangerous, and Annie Duke in the book mentions that these are almost more, well, not almost, but definitely more dangerous than the good decisions we make that have good outcomes. So given a choice between a good decision and a good outcome, or a bad decision that has a good outcome, you would always rather have the good decision that has a good outcome, because obviously if you make a bad decision that ends up turning out good in the end, first of all, you might not even realize that you made the bad decision in the first place because you're only judging the outcome. And an example of that would be what investors suffered from this past year that they don't even know they're suffering from, which is the result of the coronavirus flash crash in 2020, where the stock market went down 22 days, it went down 34%, and then it went up 34% in 29 days. So somebody who maybe would have said, I want to protect my portfolio long term, and maybe in a trend following portfolio or trend following strategy, like we have 4 trend following strategies at our office that did not do so well last year because we got out of the market in order to avoid a long term catastrophic crash, but the market came right back. So now in hindsight, we can look back, and for those people who maybe were invested and never did anything, they didn't make any changes, they didn't sell, they just stayed in the market the whole time. And by the way, we have 5 portfolio management strategies that stay in the market all the time. So we do manage both types of strategies. But if you stayed in the market the whole time, now you can look back and say, oh well, this was fine. It was a good thing I stayed in, because look, everything just ended up fine, and market came right back a month later, right? Well, again, that's one of those things where in hindsight it could have been a horrible decision. Just like in 2007, when people were in the stock market, coming out of the dot-com crash, as that recovery took place. And all of a sudden, they're sitting at the top of the market in October of 2007, the market starts going down again, and now they say, oh, I wish I would have sold. Well, again, they're saying, I wish I would have sold, and I'm looking back at history, and I'm saying, I wish I would have sold out of the market. I wish it would have been more conservative, had a more conservative allocation. All those things are happening in hindsight and saying, I wish I would have made a better decision. And that's an example of somebody not making a good decision and having a bad outcome. You go back to 2000, the dot-com bubble. You go back to 1973-74. There have been a multitude of market crashes over the years where we could look back and say, oh man, I wish I would have sold. I wish I would have been more conservative, and I wasn't, so therefore I lost a lot of money. And then sometimes what people do is they become ultra conservative, too conservative, to the point where they're so scared to make any decision that they just don't make any decision at all. And I always say that not making a decision is a decision, by the way. That's a decision not to decide. So what happened last year with COVID is we had this situation where the market did not act normally. The whole everything was locked down, where people couldn't leave their homes. You're getting food through DoorDash and groceries with a mask on, or they're delivering it to your car. And I guess now that's become normal these days. But the point is that in hindsight, in a very quick fashion, what ended up being a potentially regretful decision to stay invested ended up being just fine. Whereas if the market were to go through the same type of crash that it did in 2007, 8, and 9, or 2000, 2001, and 2002, and it started in February of last year, then we still wouldn't, well, we'd be about just around halfway through it, a little bit over halfway if it were the dot-com bubble, and we'd be getting close to the end or close to the bottom coming up here in fall. So if that adds some perspective, that the crash that took place last year created, again, in hindsight, some brain trash, for lack of a better word, because we never ever want to think that a decision to do or not to do something was a good one just based on the outcome, because, and this is the key, it could have been that we were just lucky at the time. And I think that's what happened last year, is that anybody who did not have a plan with any portion of their portfolio to sidestep any market, I was going to say last year's market crash, to sidestep any market crash. If you didn't have a plan and you just stayed in the market, and I guess your plan was just to do nothing and stay invested the whole time, and you're young enough to do that, or you have enough money to do that, or enough runway ahead of you to make sure you could earn the money back when, not if, the next big, huge market crash occurs, in hindsight, the market went down for 22 days, and it came right back in 29 days. And that's what's been happening the last 12 to 13 years, and it's actually one of the only things that makes me fearful. And I'm not fearful of the market, by the way. I'm fearful of the psychology and what the market has taught people to behaviorally think as humans, which is, for the last 13 years, that the market, when it goes down, it just comes back 2 to 3 months later. And that's it. That's just how the market is. And we're never going to see another big, long crash again. So what's going to happen is the market is teaching everybody that the market comes back. Every time it goes down, it comes back 2, 3, 4 months later at most. And when the next big drop does occur, when we get a huge recession, one that's more, call it normal, I hate to call it that, but that's the fact, is that the average market crash is 16 to 18 months long, and the average drop is about 42%. So my worry is not for the market. My worry is for the investors that decide that, because it's like the boy who cried wolf, the market who cried crash. There we go. There's another podcast. But it's the market who cried crash, and it's just never going to crash again, and we're not going to see 18-month drops in the market anymore. So that's my concern. But we never, ever know all the information. We never know what the market's going to do in advance, unfortunately. So that's why we have to have a process. We have to have a plan. And so when we get into talking about a plan, let's talk about that Stanford virtual reality study. And this is really interesting. And what they did at Stanford is they used virtual reality software to compare two groups. One group would look at themselves in the future, and then the other group would look at themselves as they are today. So basically, they'd be given a hypothetical basket of money, and they could allocate as much as they wanted to retirement savings or not. And what was interesting is the first group saw their current selves immersed in this virtual reality environment, but it was basically like looking in a mirror, and they were just seeing themselves as they are today. And then the second group, what they saw in the virtual reality environment was an age-morphed version of themselves in the distant future. So it was almost like looking at themselves when they were 60, 65 years of age. And what was really interesting about the study is that the amount of money allocated toward retirement savings for the first group, the people who were looking at themselves in the mirror as they stand today, was $73.90. And the allocation amount isn't important, it's the difference between the two. So $73.90 was allocated towards retirement savings for the people who were looking at themselves in the mirror as they stand today. For those people who saw themselves in the future, who saw themselves as older people, they allocated $178.10, or more than 100% more than the first group did, just because they saw themselves in a future light. So I thought that was fascinating. Obviously, it's a little bit expensive to be using virtual reality with every individual on the planet to get them saving for retirement, or at least saving more for retirement, I should say. But if there's one thing that this makes me think of, it's this famous quote, and it's only famous, I guess, in our office, but I hear all the time, if I had a nickel, for every time I heard the phrase, I wish I would have started saving earlier for myself, or I wish I would have started saving sooner, I'd be rich. I'd be filthy, filthy rich, because everybody always says they wish they would have saved sooner. And the reason they don't is because other things are more important. We live in a society of immediate gratification. We want what we want now. We have a really hard time as humans looking way out into the future and seeing future goals as reality. And then before you know it, time flies by and it goes so fast. And then you're looking at yourself in the face at 40, 45, 50 years of age saying, oh man, I didn't save nearly as much as I should. I feel like I'm behind. And then if it's even worse, when you get to that point in your life and you're so nervous and scared that you don't do anything at all because you just don't want to face that reality. I guess that's the irony here with virtual reality, is that real reality at 45, 50 years of age, if you don't feel like you've done enough to save for yourself, that's the time to get in front of somebody, like whether that's doing your own research and your own retirement planning and looking online for tools to help yourself and your family, or if that's sitting down with a professional such as ourselves, financial professional, RIA, registered investment advisory firm, fee-only fiduciary, to do some retirement planning, put together an official full-blown retirement plan. And the kind of thing that we do at our office, and the kind of thing that you should do, is you should be looking at things again in probabilities, not certainties. Is it 100% certain that if you save X, you will be able to retire and never run out of money? Whatever X is, the answer is no. Nothing is certain in life. I think we already know that. We all know that. So what we do, aside from a linear analysis, the first type of saving of retirement projection, or saving for retirement projection, or being in retirement and knowing if our money's going to last forever, is to look at a linear analysis. And that's where we would just simply look at, say, a 3 or a 4% withdrawal rate. And then we say, well, if we take 4% of our portfolio every single year, how much are we going to have left at the end of the day at an assumed rate of return of let's just say 3%, 4%, 5%, or a real rate of return above and beyond inflation. So that's one way of doing it. The same can be done for saving for retirement. So if we're in our 40s or 50s and we're looking at retirement, and they say 15 years from now, 10 years from now, 5 years from now, we can say, how much do we need to save between now and when we quit working to ensure A, we get there on time, and we can make work optional, right? But not only that, but how do we make sure we never run out of money in retirement? Now, I've kind of gone backwards here, but when we look at that, we can look at that linear analysis. We can say, well, what if we earn 4% per year? What if we earn 5% per year long term? But the problem with that is it's linear. And if we go back to Annie Duke's book about, again, thinking in bets and thinking in probabilities, not certainties, because there are no certainties, that's where something called a Monte Carlo simulation comes into effect. And an example of a Monte Carlo simulation is where we take a look at, say, 1,000 trials of possibilities. These are anything from the worst possible market environment you could possibly be faced with when you quit working to the best market environment. So we could be looking at, we retire at 65 and what we're faced with is the 90s, one of the best decades for the market in history. Or we could be faced with retirement in 2000 and we could be faced with one of the worst decades for retirement in history. But when we look at all these trials, say 1,000 trials from the best to the worst and everything in between, what we're looking for is what's the probability, because again, there are no certainties, what's the probability that we make it from now to the day we die without ever running out of money using all the assumptions that we have? And that's including, again, the best situation, the best possible, call it deck of cards that we're handed, or the worst hand that we are dealt. Not to go back to Annie here, but when we're looking at a financial plan, we're looking at your retirement living expenses, fixed expenses, things like your utilities. If you have a mortgage, which the goal for most people is not to not have a mortgage in retirement, but if you do, what's your mortgage? What's your property tax payment? What's your home insurance payment? What do you pay for groceries every month? What do you spend going out to eat every month? Which, by the way, is the number one thing that people underestimate, is going out to eat and the cost of breakfast, lunch, and dinner out. People always underestimate it. So we got to make sure that's correct. What about cell phone bills, cable, TV, Hulu, Netflix, Amazon Prime, all that fun stuff? So we have to take all these fixed expenses, and then we have to look at, well, how often are you going to buy a new car in retirement? And it doesn't have to be new. It could be a used car. But net after trade-in, what's that cost? And every how many years are we going to get a new car or replace a car? Maybe you're going to go on vacations. Maybe you have a condo in another state or even another country, and you want to spend time there. What's that going to cost? Maybe you want to visit family on an annual basis, or maybe you want to do it quarterly. What's that going to cost? We need to extrapolate that out into the future and adjust it for inflation. What about big trips, bucket list items, things that you've always wanted to do but never did because you didn't have the time, money, or both? Things like, I've always wanted to go to Ireland. I've always wanted to go to Scotland, and I haven't gone yet. But I'd like to take my kids back to Hungary because a bunch of my family members are in Hungary, for instance. So we have to take these ideas, we throw them into the financial plan, and we say, are we on track? Are we on track to quit in when we'd like to? And if we're not, then what we can do is look at some what-if analyses. What-if analyses might be, what if we save more? And how much could we save more? Where do we save it? Is it in our 401k, 403b, 457 deferred comp? Is it in our Roth IRA? Is it in a brokerage account? What if we retired a year later or 2 years later? How might that look? What if we only partially retired? So what if we quit working full-time doing what we're doing now, but then we want to go and we want to do something else that we maybe enjoy a little bit more, that isn't so much work per se, and now we're just going to go out and have fun, but make money doing it, helping to pay for health care, let's just say, if we want to retire before the age of 65 when Medicare kicks in. What if we spend less? I mean, I guess that's the three things, right? Save more, retire later, spend less. Those would be the three options if our probability of success is not good. Now, in the case of an example client that I'm using here is, this client, let's just say, has a 95% probability of success of making it from now to the end of the second spouse's life without ever running out of money. Well, that person's in great shape then, and now we just need to do stress tests. Well, what do you mean stress tests? Well, stress tests would be, what if one of the spouses ended up going into a nursing home at 85 years of age, using the current average nursing home cost in your state, and I'm just using Ohio, at $72,000 a year? What would happen to the financial plan if that person at 85 years of age, let's just say, went into a nursing home for 4 years? Well, the bad news is at that point we're probably not going to do too much traveling, right? So we're not too worried about all the vacations and trips and things like that, road trips, trips to the condo overseas, let's just say. In fact, we might even want to sell the condo. Maybe we don't need it anymore. Maybe it's time to kind of cash in on some of those fun things and move on to the next chapter of our lives. But in a stress test, what we want to see is our basic needs, the things that we need to survive on a daily basis. We want to see the probability of success of those things going well. And in my example here, I'll say that we have a 90% rate of success, or 90% chance of making it from now to the end of our lives without ever running out of money, even if we went into a nursing home at 85 for 4 years at an average rate in today's dollars of $72,000 per year. So that's good. That's what we want to see, and that's what we want to plan for. So as I go through all this, I know we talked about, I kind of opened this up talking about the market and how, people are focused on whether or not we're going to have a market correction. There's a market correction every year. On average, in fact, the market drops anywhere between 10 and 14% once per year. Then, by the way, the market goes through a pullback of 3 to 5% on average 3 times a year. So it's normal to see these kinds of pullbacks and drops in the market. And then in this market that we're living in right now, which is so weird, we have a very small handful of huge stocks, big mega cap stocks that are making the Dow and the S&P look like the whole index is going up. In fact, if we go back to Annie Duke's lessons about making decisions and making assumptions, I'll say in this case, and saying, well, because the market is up, that must mean all stocks are up. Well, as I mentioned earlier, what was I saying? The 18%, the average NASDAQ stock, or the median NASDAQ stock, is down 18%. The average S&P stock's down 8.2%. That doesn't sound like all-time highs to me. Mid caps down 13%. Small caps down 18%. I mean, that doesn't sound like all-time highs. That sounds like a market that's been pretty much going through its own little correction, if we want to call it a stomach flu, for the last, 5 months or so at this point. It's pretty much since February 12th or so. So I think we've kind of already been going through a correction under the surface. The question now is the market going to catch up to or the stocks in the market going to catch up to the S&P, or is the S&P going to catch down to the stocks? And my bet is probably is that we're going to see the market higher by the end of the year. And that's just my opinion. Obviously, no guarantees, right? But at the end of the day, we can't be worried about what's going to happen in 2021 with the market or what's happened the first half of the year, second half of the year, because it can be so frustrating to pay attention so closely on a month-to-month basis to what the market's doing. Because at the end of the day, we all need to be invested. I shouldn't say we all need. Most of us need to be invested in the stock market in one way, shape, or form, if for no other reason to keep up with inflation long term, which, by the way, we've become very spoiled with. And when I say spoiled, I mean we've been given 2.5% to 3% inflation for pretty much 3 decades. Now, I'm not going to sit here and predict that those days are over and now we're going to see 6, 8, and 10% inflation. I'm not making any predictions like that, but I do think that there's a good chance we could see higher inflation from here. And if that happens over the next 10, 20, 30 years, then it's going to be pretty difficult to keep up with inflation if we don't have some of our money in stocks. So what we need to understand then is that there's going to be volatility, ups, downs. There's going to be times when the market makes sense. There's going to be time when the markets don't make sense. But long term is where we need to be focused. We need to, I always say, stay focused on the horizon and not our feet. When we're driving a car, we're not staring down at the dash. We're looking up, at the horizon. When we're riding our bike, one of the things I keep telling Camden, my younger son, when he rides his bike, he looks down at the tire and he's wobbling all over the place. And so I'm trying to teach him to keep your head up, keep your eyes ahead of you, because what's going to happen is you're going to have more volatility. You're going to wobble all over the place and potentially crash your bike if you focus too much on the short term. And the analogy there would be you're going to abandon your financial plan. So you're going to abandon the long-term plan if you allow short-term volatility and the strangeness and weirdness and the scariness of the stock market to give you ulcers and make you worry in the short term. So when we think about the wind and weather being the stock market, so we just had a storm today. Today's Thursday. That wind, the rain, the storms, it's going to make us want to quit. It's going to make us want to abandon our financial plan. And the number one thing we need to do on an ongoing basis is, if we're not retired yet, we want to have a plan, have a financial plan, retirement plan, and we need to put one foot in front of the other, and we need to save and make sure we're following that plan. If we're retired already, then what we need to do is we need to be focused on our withdrawal rate, our portfolio allocation, how much we're spending, and making sure we're staying relatively conservative and we're not spending too much relative to the amount that would be reasonable for a withdrawal rate from a portfolio. So I don't want to spend any more time talking about all the details, but bottom line is you need to have a financial plan, comprehensive, written plan, put one foot in front of the other, to manage your savings pre-retirement, to manage your spending post-retirement at all times, no matter what the stock market throws at you, because it will throw some curveballs. Make changes and adjustments to your investment strategy as needed on an ongoing basis, because you shouldn't just set your portfolio up and just leave it and let it go. And if that's what you've done in the past and it's worked out right so far, that's great. But remember Andy Duke's lesson that we don't want to take the outcome and say, well, because we said it and we forgot about it and it worked out, then that was the right decision. It just means that we probably got lucky, and that's okay. Nothing wrong with a little luck. In fact, a little luck's always helpful when it comes to the retirement planning in the stock market. But at the end of the day, once we have our plan in place, if we don't follow the plan, it's worthless. So that's the last piece of the lesson here, is we want to make sure we're sticking to the plan at all times and understanding that whenever there's short-term setbacks, whenever there's the market's throwing curveballs, whenever things don't make any sense, whenever you hear on the news things going on with inflation, government debt, who's the current or the next president, all those things are short-term noise that you need to ignore, and you need to pay closer attention to what the market is doing, to what's in favor. Is it domestic? Is it international stocks? Is it commodities versus stocks? Is it bonds versus commodities, or bonds versus stocks? And then how are you going to have your portfolio allocated in a way that matches your financial plan output and your personality from the standpoint of how you cope with, handle, and deal with risk from a behavioral standpoint. So that's all for today's show. Feel free to share this episode with your friends and family. And if you'd like to discuss your personal situation further, remember that you never ever have to be a client to ask a question. If you'd like to set up an introduction call or Zoom meeting, head over to our website at libertaswealth.com to schedule something on our calendar. There's a link on the contact page that literally gives you access to our calendar. If you can't get in as soon as you'd like to and it's an emergency, then just call our office and we will make sure to work you in. As always, I always say there's thousands and thousands of podcasts out there, and you chose to give ours a listen today. So thank you so much for tuning in. Be sure to subscribe on iTunes and YouTube, and remember, you can sign up at libertaswealth.com to get not only these updates and to your subscription, but also all the other screencast videos, articles that we write delivered directly to your email inbox right when they're distributed. Feel free to follow us on Facebook. We're on facebook.com/Libertas Wealth. I'm also on Twitter at Adam Koch, as well as Instagram at Financial Surgeon. And that's it for today. So thank you so much once again for joining us, and we'll see you next time.
Thank you for listening to the Cash Podcast with your financial surgeon, Adam Koch. To see any charts or images that were mentioned in this show, or to check out additional articles, videos, and other educational resources, head over to libertaswealth.com.